Ooh, that's really loud. Can you hear that? We now have a PA system in the back for those having trouble hearing us. I don't know who has trouble hearing us, but welcome everybody. It's glad to see y'all again to our investment supper. We are Joseph Financial Partners. I'm Jody Donovan. Sharon Joseph will be speaking with us tonight. We also have Jim McAfee back in the corner, our assistant Jenny Jones, and our other assistant, Pris Williams, up front. So thank you all for coming. We always like to help educate people. First thing on the handout, does everybody get a folder? Because all the slides that are up here are in that handout. Some of them are kind of small, so you can't really read them. Maybe if you have some good glasses, you might be able to read some of those words. But all the slides are up here, so you're not going to miss anything. There's also a comment card inside the folder. We'd like you to fill that out. Tell us how we did. Tell us things you'd like to hear about, or any kind of comments that you want to give about the food or the location or anything about tonight. Right, Luis?
Yes, sir.
Okay, and then also in your handouts, just so you know, we are also doing an American Fund shareholder dinner. Most of you that are clients own American Funds, which is, we believe, one of the best mutual fund companies in the world, and we have our representative from American Funds coming in October, so that's the other flyer in your handout. So tonight what we want to talk about is focus on the long term. What we did was combined a little bit of American Funds research and a little bit of LPL financial research, and kind of combined some of the slides we wanted to share with you that have to do with the economy, stock market, and the bond market. So first, Sharon's going to talk about the economy, then I'm going to talk a little bit about the stock market. She'll talk about the wonderful boring bonds, you called them, and then we'll take any questions after that. So Sharon?
Okay. Can you hear me okay? Is it coming through? All right. Thank you. It's the first time to use a microphone, so I'm not quite sure how loud to speak. I'm used to trying to get to the back of the room from up here. So I get to talk about the economy. Why not? Because everybody is. Everybody seems to be debating what's going on in the economy, and nobody's really sure. And I've kind of come up with an analogy of what it's like. It's like driving a big yellow school bus down the road. And in the back rides the stock market, the bond market, the real estate market. They're bouncing along with the market, and we're headed down the road. The only thing is the windshield's blacked out. You have the big side view mirrors, you have the rear view mirror, but you can't see going straight ahead. Not you, not me, but all the economists, all the analysts that are trying to tell us what's going on with the market. So we're headed down the road, and right now we felt all of a sudden it feels a little rough. We got some gravel going on. So we look in the side view mirrors, and what is it? Inflation. Scary stuff. Inflation. Maybe 9–10% inflation. People don't like inflation. Food's going up, oil's going up, the supply chain's all knotted up, and people are uncertain and not happy with what's going on. And it looks like the central bank, the Federal Reserve, is not doing their job, or it feels that way. It feels that way when you have high inflation. So the Fed steps in. Now remember, they're driving the same bus that I'm talking about. They can't see either. They only have the rear view mirrors. And they say, okay, well, we need to raise interest rates to step on the brakes a little bit. So it's just like stepping on the brakes on the bus, slowing it down a little bit. And of course, the market doesn't like that. It's jostled around in the back seat of the bus, and you've been through all of that. But it's what we have to do to get it under control, because we can't just let inflation run wild. So the Fed's raising interest rates, the market's not liking it, and the Fed is just trying to live up to their mandate. The central bank is mandated with keeping employment full and prices stable. So if prices are going up 8 or 9% a year, that's not stability. So that's why they're raising interest rates. The question becomes, has this started to drive us into a recession? That's the big debate right now. In fact, I just read a report that it is the most Googled term in the last month is recession, trying to find whether we're in one or not. And we had a flippant definition for inflation. We said if we had 2 quarters of negative GDP growth, that was a recession. Well, we've had 2 quarters of negative GDP growth, but what usually goes with that is layoffs, a downturn in the job market, a default on mortgages and credit cards. Household spending goes down, and none of that has happened. All of those parts of the economy are extremely strong. In fact, the lower part of the economy, the lower income people, have 70% more in their bank accounts now than they did in 2019. The corporate balance sheets look good, the home balance sheets look good, all of this, and so the dark windshield is even darker than usual. We can't tell what's going on. Are we going into recession or are we not? Bank of America and Goldman Sachs have both predicted that there's going to be a worldwide recession. So let's take a look at what's going on with the world economy. So what we have here is the cycle of the markets. So you have the cycle of the economy. So we've got an increase, a peaking, and a decrease down into a recession. And then these bubbles. I love this graph. This is so interesting because each one of these bubbles is a different size because it's based on their GDP. It's based on their gross domestic product. Gross domestic product is everything that a country produces and makes. And it basically tells you the size of the economy. So you can see the biggest bubble here is this blue one, which is the US economy, which is 20.94 trillion. The next biggest one is China, which is 15 trillion. And China seems to be leading the world into a recession. That's because of everything that they did in COVID. They were so scared of COVID, they shut everything down. Of course, you can do that when you're a communist country. Everything's shut down. So their economy is limping along more so than ours is. So it looks like we're moving into a worldwide recession. So American Funds, Capital Group, home of American Funds, has put together a group called Night Watch to try and keep track of what's going on with inflation and the tightening by the central banks and what's going on with the war in Europe. And so they call it Night Watch because they've put together their best economists, their best portfolio managers, and their best analysts and have them looking in different directions. The name comes from this painting by Rembrandt, which it's a dark night, but if you'll notice, every face is looking a different direction. So they named the group Night Watch because they're all trying to look at something different in the market. And so it's set up where if things get worse in the global recession, it goes this way. If things get worse in the war, this way. If things get better, it goes this way. If things get better with the war, like there's a peace relief rally, it goes this way. But one of the things I want to call your attention to is the word inflation is in every one of these boxes. So what we're saying and what they're saying is that inflation goes on even as we work our way into this recession and as the Fed is raising interest rates. So this isn't the first time the Fed has raised interest rates. The question is, when they raise interest rates, do they drive us into a recession? And that's what this graph is about. It goes back to 1986, and this blue line is the Fed funds rate, and the gray columns are recessions. So it's saying, when the Fed raised interest rates, did they drive us into a recession? So let's take each one of these and see if they kind of fit with where we are right now. Back in the 80s, you remember this, the Fed raised interest rates, and the Fed funds rate got up to almost 10%. We had high debt, we had high oil prices, and then Iraq invaded Kuwait, and we went into a recession. But they were already lowering interest rates before we went into it. So we went into a recession. Fed brought interest rates way down to stimulate the economy. They bring interest rates down when they want to stimulate it. So they stimulated the economy, and it worked. The economy was growing really well, and the stock market was doing really well. In fact, we were paying money for stocks that didn't even have any earnings. That was when Alan Greenspan, talking about the market, used the term irrational exuberance. In other words, stocks were going up faster than they should. Some people refer to it as the dot-com bubble. Well, the dot-com bubble broke, and we went into this recession. And so After the recession, when we go into the recession, the Fed brings the interest rates way down, so they're down here, and they begin raising them again, stair step, stair step, stair step. And the economy's doing really, really well. In fact, it's doing so well that people are taking their homes with mortgages, then they use the equity in their home to buy another home, and the equity in their home to buy another home, and they stair step on top of each other. We aren't that familiar with that here in Texas because we didn't do it, because we didn't think of our home equity as a savings account that we could just tap into. That's because we'd only been out of the Homestead Act for a little while. We couldn't do it for most of our history. So we weren't as familiar with it as they were in California or in Florida. So what happened was we had very easy money. It was easy to get credit, and people built pyramids of mortgages. And so they all fell in on each other, and we had the housing shut down. So we had to bring interest rates way, way, way down to stimulate the economy. You probably all remember this. They named it the Great Recession. It was terrible. It was a terrible time. And so interest rates stayed low for a very long time. Then the economy starts doing better, and we start stair-stepping out of it. And then along comes COVID, and we shut everything down and have another recession, and to stimulate, we bring interest rates all the way down to zero. So now we're trying to work our way out of that, and that's where we are, and we're predicting that interest rates are going to go as high as 4% in 2023. So the answer to the question is we may be moving into a worldwide recession, but things look better, but they don't look like it doesn't look like any of this to me. What it looks like to me is the recession that we had in the mid-40s. If you think about it, you can compare the time right after the war to where we are right now. We certainly shut the economy down. Factories that were making tractors began making tanks. Industries that sewed blue jeans began sewing parachutes. We took the entire workforce and sent it out and put in a substitute workforce. And then after shutting it all down, we tried to reopen it again, kind of like the COVID shutdown and reopening. So there are a lot of similarities. Well, we had inflation at that point in time, and it pushed us into a recession. But we've forgotten all about it. We don't even refer to that recession or that inflationary period because the time was followed by so much prosperity. Decades and decades through the 50s, the 60s, into the 70s of prosperity. To me, it looks like that's where we are. We're just not there yet. We're going to have to work out this inflation a little bit more by raising more interest rates. So, as the economy goes, so goes the stock market, they say. Let's see what Jody has to say about that.
Right. So as she's saying, we're in a mid-cycle term, but when you're looking at stocks, we got the black shield in front of us in the bus. We can only look back. And so what we're looking at on this first graph is historical rise of the Dow Jones Industrial Average since 1900. And just to clear, and what you see here, the blue line is the Dow Jones. There's the Great Depression, there's the Great Recession. But that orange line down the middle shows it's a 9.5% gain year over year historically on average. And what the Dow, you're going to remember, since we're talking about the economy, is why we lead into the Dow. The Dow Jones Industrial Average was started in 1896 as a barometer to measure how the economy is doing through the eyes of the stock market. So currently, the Dow Jones Industrial Average, this is in your slides or in your handout, but currently there's 30 stocks in the Dow. And the Dow Jones, they change it whenever they feel that a company is not representing the economic industrial growth. That's what the key word there, industrial. It's not so much industrial anymore. But you see there's healthcare, there's Boeing, there's Caterpillar, there's consumer staples. But this thing has been changed 57 times since 1896. Just currently in August of 2020, they added Amgen, Honeywell, and Salesforce by removing Exxon, Pfizer, and Raytheon Technologies. Sorry, easy for me to say. But they can, when they move it around, that becomes just the new Dow Jones. So that's, when you hear it on the news, that's the Dow. just know that that's 30 stocks that are kind of representing how our economy is looking through the eyes of the stock market. And just for giggles, I wanted to see that 1896 lineup. The first 12 stocks were these, which the only one I recognized was General Electric. That was GE. That was in there for a long time. United States Rubber Company became Uniroyal. Distilling and Cattle Feeding Company became Jim Beam. So these were, again, they were changed 57 times since 1896, but it's always been a representation of the economy at that time. So you can see there's Chicago Gas Light, Tobacco Company, Sugar Company, Cotton Company. That was the Industrial Revolution time, so that's why it's called the Dow Jones Industrial Average. So getting on to the S&P 500, which I think is a better representation of the U.S. stock market because that's the top 500 companies in the United States. So this graph is showing how those that try to time the market can't ever do it right. You're trying, I know it's going to go down, it's going to go up, I'm going to get in and out. It doesn't work. And this is an example of going three decades, from 1990 to 2021, the S&P 500. Had you just stayed in the S&P 500 for those 3 decades, your return was 9.9%. If you just missed the one best day in that whole 30 years, your return was 6.1. If you missed the 2 best days, you don't know when those were, it was in a 30-year period, just missing 2 of the best, your return was 3%. You missed 3 of the best, you're flat. You miss 20 of the best, you're at negative 24% in that 30-year span. So you can't time the market. We don't have a crystal ball. Remember, we got rear view mirrors. We can't see forward. So we don't know what's going to happen, but we can look back as a reference. So timing the market is not the way to do it. And when you panic, if something's going wrong like it is now, we see people, we have clients calling us, should I get out? Should I get in? You should stay the course. This shows when panic attacks due to investors. This is annualized returns over 20 years, and it's different sectors of investing. The top line is real estate investment trusts. Over those 20 years, REITs is what they call in the acronym, Real Estate Investment Trust, did 10%. The U.S. stock market did 7.5%. International stocks did 5%. Government bonds did 4.5%. Home values went up 3.7%. But look at that. The average investor did 2.9%. Why is that? I'm trying to time the market. They miss some of the best days. So you can't look forward, you can't time the market. The best idea is to stay the course. This is a really cool graph because remember, we're in the midterm of an economic cycle. And what this graph is showing, it goes all the way back to 1960, the annualized returns of the S&P 500 at the end of the year, and they categorize them by different returns. So all the way over on the left, the 2008, 1974, that was negative 25 or more loss in that year. The next column is between negative 15 and negative 25. This next column is between negative 15 and negative 5. The yellow column is negative 5 to positive 5. And then the blue one is 5 to 15, 15 to 25, and over 25. You can see it's heavily weighted on the right side, that the majority of the time in a mid-cycle year, in those years, it was positive. But the highlighted ones that are bolded and highlighted, those are mid-cycle years. Remember, we have the mirrors. We're looking back. We know those are mid-cycle years. In all 30 of those, the average return was 11.5%. With only 1977 and 1966, those are the only 2 years where there was double-digit loss returns in the S&P 500. So what this tells you is, hey, annual declines are, they're big annual declines are rare. This left side, this negative 25 and negative 15, they're very rare, even looking back as far as 1960. So know that with all this volatility, that the markets will come back. It may not be this year, but they do come back. And speaking of volatility, this graph is pretty interesting. I know you can't see it on yours because I tried to read it myself with magnifying glass. It's very difficult. But what this shows is the S&P 500 returns from 1980 to present. And the blue line is that year's return. So the first year, it returned in 1980 rather, 25% growth. But these diamonds down here are the biggest maximum pullback that happened in that year. So for instance, in 1980, that negative 17.1, that was the biggest drawdown in that year, but we still ended the year up at 25%. Or for instance, in 1987, there was a negative drop of 33.5% in that year, but that year still ended up 3% positive. Or one you might remember very well in 2021 or 2020, the COVID crash we talked about, we had a drop of 33.6% that year, but ended up at close to 20% returns for the S&P. So what this shows you is the average their average pullback, that yellow line right there, is 14.2%. That's the average maximum pullback for those since 1980. So what it's showing is volatility happens. We've seen ups and downs. That's what the market does. But how they end up the year is really what matters in your portfolio. So again, staying the course, riding the volatility out. Excuse me. And now we're in this, Sharon mentioned, this Fed rate hiking period. That's what we're in right now. Well, we check the rearview mirrors again and look back at other times when the Feds were hiking rates. And so what this graph shows is when they were hiking from the first rate hike to the last rate hike, where it started, where it ended, how many times it went up, and then the percentage in the S&P 500. So in 1946 to 53, the period that Sharon was just talking about, similar to where we probably are right now, the Fed funds rate started at 1%. It ended at 2% after 5 slow rate hikes. And over that time period, the 46 to 53, the market was up, the S&P was up 40.3%, which is averaged at 5.2% a year. Or look down here at when 77 to 80, when rates were so high. I remember having a 13% CD. Do y'all? It was how I got my first down payment on my first car. But 77 to 80, it started, the Fed fund rate was at 6.25. They got it up to 21.5 after raising it 60 times over those 3 years. During that time, though, the total percent return during the cycle was 35% with an average annual return of 8.7. That's pretty good with that many rate hikes and that much uncertainty with the windshield blacked out. Or so basically what they're saying is out of all these time periods, there's 11 time periods that they looked at. 8 of the 11 were positive after the rate hike. There were only 3 times out of the 11 where it was a negative return. So the average during those cycles is 11% total during the Fed rate hiking period, with an average annualized return of 4%. So again, we're looking at the rearview mirrors. What happened when we were in a rate hiking period? They all pretty much turned out okay, is what we're trying to say here. When I mentioned panic attacks, geopolitical events, they keep happening. They're going to keep happening. We've been through wars, we've been through recessions, but what this graph shows is pretty interesting. And again, you probably can't read that on your slides, sorry. But this shows geopolitical events from recently Russia invades Ukraine all the way back to Pearl Harbor. So for instance, the top line says Russia invades Ukraine on 2/24, 1 day gain of 0.4, but we don't know what's going to happen after that. So looking at, for instance, the 2 below that, the COVID crash, the third line down, COVID crash of January 20th, 2020. It dropped 0.3% on January 20th, but it totally drew down 33.9. It took 63 calendar days to reach that 33.9 drop, but it took 148 days to get back to where it was before the drop. You see how that works? And so you go down, there's some here, Iraq's invasion of Kuwait, that was a pretty big one. Dropped 1% that day, almost 17% over 71 days, but it took 189 days to get back to where it was. So those are pretty dramatic events. Even this blue line right here is a division of when the S&P 500 started, because before 1957, it was the S&P 90. So that's where there's the division there. But during the Pearl Harbor attacks, the S&P 90 dropped 4% the first day, 20% over 143 days, and took 307 days to get back to where we were. That was that industrial era where we were really struggling. But what we're showing here is that the market is resilient to geopolitical events. Wars are going to happen, recessions, crisis, terrorist attacks, they're going to continue to happen, but the stock market is pretty much resilient from that. So keeping the panic down a little bit. The last slide I'm going to show you is dealing with dividends. More specifically, global company dividends. And what American Funds is showing here is that over the past 12 months, global dividend payments have risen by 20% meaning 1.9 trillion more over last year. And what we're showing, and these are kind of box graph representative, but financials paid $541 billion in dividends. Energy companies paid $259 billion in dividends. So it's just a large number of dividends that are increasing, and that's the important word, is increasing. The yields on these, for instance, materials is the highest yield in dividends over that year is 3.9%. That was the dividend yield on materials, which are the things that we use to make stuff. Energy was 3.8, utilities 3.2, but basically the dividends are reliable and dependable. May be boring in some of these companies, but one of the quotes that I wanted to share with you is from an American Funds portfolio manager that monitors global stocks. She said, in this low inflationary environment, I am focusing on companies with manageable debt and sustainable dividends. We're finding many across a range of sectors that are increasing dividends by 10% a year. That's huge because dividend growth commitments are a critical signal by management about their confidence in the future earnings of their company. So if they can commit to raising their dividends, that means they're confident in the growth of their company. I thought that was some good insight in sharing dividend growth. And remember also in times like this, dividend payers are buying more shares while the market's on sale. So having those dividend payers during volatile times is a benefit in the long run. And some of the companies that she recommended, these aren't recommendations, but these are examples of companies that are increasing their dividends. Chevron, EOG Resources, Vail Mining, and Raytheon Technologies, just as examples, not recommendations. And so Sharon's going to finish up with the bonds.
Okay. Beautiful, boring bonds. So, yes, ma'am.
I do have one question. What was the last about Sharon?
Oh, those are examples that this American Funds money manager suggested as companies that have been increasing their dividends on a regular basis.
Oh, okay.
Those are just some examples of dividend growers.
Oh, okay.
Yes, ma'am.
So what we've learned is that you have handouts that you can't read. So there are two really good pieces in your folder that you can read, and one is the invitation to the American Funds dinner, which is free. You have to go to Kerrville, but the food's going to be really good, and American Funds is going to pay for it. And the other thing is the drawing for a dinner here at Nuri's, and I know you can read both of those even if you can't read the slides. So it sounds like you can read the important stuff. So we're going to talk about beautiful, boring bonds. We own them for two reasons. We own them for income, and we own them for insurance. They're not supposed to go down as much as stocks go down. So have they done their job this time around? Well, they just had their worst year in 40 years. Bonds went down 10% in 2022. But the stock market went down 20%, so I guess we could say somewhat they did their job, and they kept paying income during that time period. So how has it been with bonds when we've had other times like this? So other big declines in the bond market suggest that better days are ahead. So what we've listed here is all the times where the Fed has raised interest rates before. So if we just look at this 4-year period from 1977 to 1981, when the Fed raised interest rates 14.89%, that year the bond, in those 4 years, the bond market returned 2%. But the very next year, the year after they stopped raising interest rates, the bond market went up 13%, and the year after that, 30%. So if we just look at the averages, the years that they're raising interest rates, bonds did not do that well. But the first year after and the second year after, they did really well. So it's a good time to add them to your portfolio so they have them to do well as we see the better days ahead. The market has already priced in a bunch more Fed raises. Remember that the Fed is only changing interest rates as to what they loan banks overnight. The Fed controls the overnight rate. Everything else is controlled by the market. It's buyers and sellers trading with each other. And so the bond prices go where investors believe they're going to go. So we're already out here to 3.25% to a little over 3.5%. on the treasuries. But one thing that you'll find interesting here, remember the market is pricing this in, the Fed isn't controlling it. Notice that the 2-year pays more than the 5-year, which pays more than the 10-year. That tells you that the people who are buying and selling bonds right now believe that interest rates are going to go even higher. They're pricing that in. The good news is income's back. I don't know if you remember how bad it really was, but this graph tells you these are the recent lows. But you know, if you loaned your money to the U.S. government just recently, you got half of a percentage point. That was your annual income. But that's gone up 2.79%. So now if you loan your money to the U.S. government for 10 years, you get 3.29%. If we look at investment grade corporates, like the names of companies that Jody had on the screen, you could loan them money and they would pay you 1.74%. No wonder we didn't buy many bonds during that time period. But now they've gone up 3 percentage points to 4.8, and that's for high quality companies. The lower quality companies have gone from 3.53 to 8.32%. So some pretty good rates there. And then even municipal bonds, the tax-free bonds, 8.6% up to 3.37. These are some really big jumps that have been caused by interest rates being raised by the Fed. If we look 5 years ahead, it looks like it's going to be even better. This talks about the total returns of the bonds. So bonds pay interest, but they also have value. So when we're talking about total return, we're talking about the interest that they pay and the value that the bonds are worth. So what this graph is showing you is that looking forward, if we look backward 5 years, it tells us that if we look forward 5 years, we expect these kind of returns from these bonds. And my final slide is my favorite. Tax-free bonds are a big passion of mine because we don't get to say tax-free very often and mean it. Tax-free bonds are actually tax-free. They're tax-free because they provide funding for things that are needed by the population. So it's bridges, roads, hospitals, schools. They borrow money and they borrow through municipal bonds. And so if you buy these municipal bonds, you get tax-free interest. You don't owe taxes on them at any time down the road. They could cause your Social Security to be taxed if you have enough of them, but it's still tax-free income. And so what we have to look at when we look at tax-free bonds, they pay a lower rate. Remember, if I go back, if we look at these rates right here that have been raised, you see that they're lower than most of these other things. That's because of the tax-free nature of them. So we have to use something that's called a taxable equivalent yield. We have to find a way to compare taxable bonds to tax-free bonds. Our income tax is in tiers, so we have tax brackets, and our tax brackets range from 10 or 12% out to 37%. But most of us fall in the 24 to 32% tax bracket. So for most of us, if we buy a taxable bond, a quarter to a third of the interest that we earn goes to the IRS. If we buy tax-free bonds, we get to keep all the interest. So we have a chart like this that helps us understand that. Like if you have a high-yield municipal bond and it's paying 5.75%, and you have a U.S. Corporate high-yield bond that's paying 8%, you would think that the 8% was better than the 5.75%. But it's not if you add in the tax-free nature of it, which makes this bond worth 9% because you got to keep all the interest. Does that make sense? And then on the average one, it's both municipal bonds and the bond aggregate pay about the same. But if you're in the 30% tax bracket and you get to keep all of your interest, it's a like 5.75% yield. So tax-frees, love them. Okay, Jody, let's sum it up.
Well, you talked about the economy is in a mid-cycle.
Right.
And
we still have inflation.
Still have inflation.
So we're still going to be raising interest rates. And you talked about the stock market. You said don't panic.
Don't panic. Stay the course. Stay the course.
And I talked about the bond market and said it's paying more now, but it's probably going to pay more in the future.
Yep.
So better income.
And last slide is, or what?
Go ahead.
just next month.
Oh, wow, this is so good. Y'all got to
Well,
come back and see this.
Don't build me up yet.
It's really, but the slideshow's really good.
It's basically 5 ways technology will change how you age. It's a really cool collection of, how do you say, elderly-friendly applications for your phone. So I'm not going to share too
Not
much
just your
of that.
phone, your whole life.
Yeah, you're managing your life through technology. There's a lot of good
Technology
ideas.
for Granny. I loved everything about it. So please come back for that.
Please fill out your comment cards because we're going to draw for a gift certificate. And the food's not ready yet. He's going to have it ready in about 5-10 minutes.
But it's pork
Yeah.
tenderloin with mashed potatoes and
it's pork tenderloin, slow cooked in red wine. With,
overnight.
Yeah, butternut squash, some sides,
Soup.
and watermelon. Butternut squash soup.
and really good watermelon.
Do we have any questions on this presentation? Yes, Peggy. Hold on. Let me give you this. Yeah, you do.
Yeah.
Okay, I'll repeat it, Peggy.
What if you do bond like through a school or a hospital and that hospital goes bankrupt? What happens to your money?
You want to repeat the question?
No, you.
Okay. Peggy asked, what happens if you buy a municipal bond through a school or a hospital and that hospital goes bankrupt? And what happens is if they go bankrupt, they quit paying the principal, they quit paying the interest, and most of them have insurance that pays your principal back to you, especially if you buy the high quality ones. Like we use a lot of school district bonds, which are guaranteed by the state of Texas under the permanent school fund bond. So if a school district were to go under, the state of Texas would pay the last interest payment and the principal. But it's important, you know, all of these bonds are rated, so when we talk about the regular ones and the high yield ones, of course have more risk. But many of these bonds have insurance policies attached to them. Good question, thank you. Any other questions? Other than how to read the slides that were too small to read?
There was only 3 of them. All right, well, thank you all for coming then.
Okay, visit with each other until the food's ready. It's coming soon?
Yeah, he's going to get it.
Someday, maybe Christmas.
Thanks, Louise.